Let's get a preview of what to expect now. Dr. Stephen Nash joins us from FIIG Securities. Great to see you and be great to get your thoughts, particularly on these comments from the Chicago Fed President Charles Evans.
Yeah.
Very definitive, and I know, as you point out, he is a well-known dove, but what was he suggesting? What was his argument for this latest call for action from the Fed?
Well, I think what he's looking at is further easing measures in order to make sure that the US economy doesn't slip into recession again, as a sort of risk management exercise, given current uncertainties in Europe, and also his reference to the emerging fiscal cliff in the US. So either of these risks or uncertainties could create a shock for the US economy, and that could lead quite easily to a recession, given that the US economy is, as he described, just above stall speed right now. So it's really a risk management exercise. I think that really does make sense given what's in front of us right now. Also, just looking at the sequence of events we've had to date, we've had the Yellen speech in June, we've had a paper by the New York Fed indicating that a lot of the unemployment is not structural. And we've also had the minutes indicating that the Fed's moving towards some more QE. So I think Friday should fit into that pattern, and we should get more details on what's planned by Bernanke.
It was really interesting what he was saying too about basically rates should stay near zero until you either see inflation go above 3% or unemployment go below 7%.
Yeah.
Just take us a bit through these comments.
Look, what he's saying is that the commitment to lower rates should be almost unconditional, and there should be continued aggressive QE until either of those two targets are met. Hopefully we'd meet the unemployment before the inflation target was triggered. It's basically an idea where policy becomes conditional on those two targets, either of those two targets being met. And I think right now what Evans is concerned about is effectively the depreciation of the capital stock in the US labour market. The longer that these unemployment numbers remain high, the greater the depreciation in the labour stock, and he's really concerned that that cost that's not being adequately taken into account right now.
What are some of the easing options for the Fed? What kinds of things could we see it do?
Look, I think firstly you'd probably see a extension of the tightening date into 2015 from 2014. There could be extra purchases of mortgage backs in particular, because I think the Fed's keen to get behind the housing recovery. There could also be some assistance to some of the federal authorities in the mortgage market to ensure that all mortgagees who can't roll down their mortgages at the moment, given their housing price, could do that. There may be some assistance there. I think that's been a policy target announced by Dudley earlier this year, and I think that's something that the Fed's very keen on seeing, and getting behind the recent increase in price we've seen in the median US house, and also the gradual recovery in construction there. So I think focusing on the mortgage market is something that the Fed will probably do on Friday.
What do you think? What's the market expectations then for the announcements from Jackson Hole, and what would the most likely reaction be, do you think?
As you know, the market's been expecting this for quite some time. It's been a very long and drawn out procedure. The equity market has rallied substantially already on the prospect of further easing. I'd imagine in terms of equity markets we may get a sell the fact, but the market's already bought the rumour, and the actual delivery of QE will see the market come away. We have to wait for September for that, of course. Also in bonds there's been anticipation of that, so we could also get a slight increase in yields as a result of the delivery of QE, but I imagine that the bond prices will then react to what's going on in the stock market, and I can't see that being particularly positive, given that we've come so far and this announcement has been drawn out for such a long time.
I guess looking at the risks from the European situation there, and the comments from Evans overnight, I mean, how worried is he by that situation there, and you know, whether the US economy could withstand, you know, a potential disastrous event?
Well, yeah, his comments indicate that the economy, in his view, is only just above what he calls a stall speed, or just in a growth phase. Any shock from Europe right now would, in his view, push the US economy back into recession. Now, the problem with that would be that the Fed would have to embark on even more ambitious monetary stimulus than it would if it didn't embark earlier. So I think the idea is to ease a small amount now to get that momentum going so that the economy could withstand further shocks.
All right, and just looking, I guess, then at the situation in Australia, what we're seeing here, because obviously we've sort of been managing to get through this okay so far, but do you think that's going to continue?
Look, if anything, I think the Australian economy is beginning to start to resemble what's going on in the rest of the developed world. We've been able to withstand approaching those sort of low growth levels for quite a while, but with this softening, a recent softening in the region, particularly in China, it appears as though we're getting drawn into the developed world slow growth situation, and I think that is the broad theme that's emerging right now. Bond yields have already indicated that that we're getting drawn into the low growth scenario, with bond yields having rallied to almost 2.5% recently, and I think there's more of this to come as the region begins to soften in terms of growth. Australian growth will also tend to go somewhat under trend, but that will take the next few quarters to develop, but I think that's the broad trend from here on.
Right, okay, something to be aware of. Well, certainly, you know, looking at investing at the moment, there's obviously this search for yield plus defensive type plays, and we've seen this massive issuance and demand in terms of the corporate bond market, especially these hybrid issues. Yeah. Looking at this, it was interesting to see that ASIC warning on these issues to investors recently. What did you make of that?
Well, I think what ASIC is saying is that investors have to be careful to ensure that they're buying products that they know the complete risks of. I mean, some of the issues have been of late effectively equity issues dressed up as debt issues. Obviously, some of the yields are quite attractive, and as long as people are fully aware of the risks, I think ASIC is happy with that. But I think some investors are viewing these issues as debt-like, and that they don't have much risk. I think ASIC are just trying to highlight that in some cases some of these securities are quite high risk in nature, and that people should take the time to fully read the prospectus that comes along with these issues.
Well, I mean, we've seen something like $8 billion in subordinated debt and hybrid issues already this year. Do you think that this is just the start of it?
Look, I think the demand is definitely for more stable cash flows. I think the investment community broadly is looking at debt much more seriously than they have in the recent past, and this year has really emphasised that demand's out there. People are looking in the stock market for debt issues, but there is a very large market there as well in the what we call the over-the-counter or the institutional market. The big advantage with the institutional market is that it sorts out possibly defective issues with defective terms and conditions, and they just don't get issued. So the institutional market provides a degree of protection for investors as they tend to filter out possibly suspect transactions.
Just obviously another place that investors have looked to is term deposits as well. Do you see, I mean, certainly that was a key theme from the banks this reporting season, is that is a very competitive part of the market for them. Yep. Do you see possibly the banks moving on their rates, possibly looking to cut rates, or, what do you see?
Look, in terms of mortgage rates at the moment, we have had a dramatic improvement in funding costs for the Australian banks. I imagine if it went the other way, the banks would be very vocal in how much funding costs had gone up. I noticed that there's a wall of silence at the moment about this improvement in funding costs, and I think given the competitive pressures out there, it mightn't be too long before some of the banks start reducing some of those mortgage rates. So that could assist the housing market. As we've seen, there's an improvement in the auction clearance rate. The spring season looks as though it could be quite firm, not strong but firm, and possibly an further improvement in mortgage rates may assist that.
It's going to be pretty tough for the banks, though, isn't it? I mean, if they're going to have to cut those mortgage rates to keep attracting customers, yet at the same time got to keep those term deposit rates high enough as well.
Yeah, well, in terms of the overall funding in the longer term market, it has improved dramatically. We've seen senior spreads come in about 50 basis points for 5-year, and for covered bonds improved by about 100 basis points. So there is some scope for some adjustment, I would have thought, in terms of some of the variable mortgage rates. Obviously, the pressure will still be there on the deposit spreads, as you say, the competition is quite high right now.
All right, great to get your thoughts as always. Thank you so much for joining us today. Dr. Stephen Nash there from FIIG